Welcome back. We're diving straight into General Motors' Q3 2025 results today. The numbers didn't just meet expectations. Honestly, they absolutely blew past them, triggered a massive stock surge, and the company raised its full-year guidance pretty significantly. So what does this performance really tell us about GM's strategy right now? It feels simple. The profitable past is basically buying the disruptive future.
Yeah, that's a good way to put it. It's almost a textbook example, really. Operational resilience buffering those strategic transition costs. When you look at the consensus estimates, from LSEG, the Q3 beat was substantial across, well, every major adjusted metric.
Okay, let's get straight to those numbers then, because the scale of the victory here is pretty impressive.
Right. So adjusted earnings per share, that's what the market usually zeroes in on, came in at $2.80. That is dramatically higher than the $2.31 consensus expectation.
Oh.
And revenue hit $48.59 billion, also beating the $45.27 billion expected. And their core operational profit, adjusted EBIT, was $3.4 billion. That smashed the expected $2.72 billion. Plus, they generated $4.2 billion in adjusted automotive free cash flow. I mean, these are powerful operational results.
It is a staggering performance, yeah, on the adjusted side. But if you only read the headlines, you might have been a bit confused. Because the GAAP net income, the one attributable to stockholders, was $1.3 billion, which was actually down, 57% year over year? So what caused that massive gap between the adjusted numbers soaring and the statutory accounting results plummeting?
And this is the critical insight right here. That decrease on the GAAP side was almost entirely driven by one thing, a huge $1.6 billion special charge. And this charge wasn't just, unexpected bad luck. It was a proactive strategic move, a realignment of their entire EV capacity and manufacturing footprint.
Ah, okay. So GM is consciously taking a short-term GAAP hit to proactively fix a longer-term strategic issue. They're essentially writing off expected EV overcapacity before it becomes a drag.
Exactly. It really shows management is prioritizing future capital use and reducing future losses over just looking good on the short-term accounting. They looked at the reality that near-term EV adoption is slower than they planned and said, okay, we need to right-size this now, avoid hemorrhaging capital in, say, 2026 and beyond.
Right. And that clarity on the EV side, that willingness to take a big one-time hit combined with that massive Q3 beat, well, that explains the strong market reaction. The Q3 numbers were the fuel, you could say, but the updated 2025 guidance was really the spark.
Precisely. They raised their full-year outlook across the board. It signals immense confidence in Q4 and, frankly, beyond. Their adjusted EBIT is now projected between $12 and $13.0 billion. That's up substantially from the prior range. And adjusted EPS is now $9.75 to $10.50. Again, significantly higher than the previous $8.25 to $10 range.
And crucially, that adjusted free cash flow outlook also got a boost, right? Up to $10 to $11.0 billion.
Yeah, that financial commitment is key. But what's really telling, I think, is the implied strengths for Q4. If you take the midpoint of this new EPS guidance, it suggests they're expecting about $2.02 adjusted EPS for the fourth quarter, which is actually above the current analyst consensus of around $1.94. So they're actively signaling this operational strength isn't slowing down.
Okay, so if they're taking these billion-dollar charges on the EV strategy, the massive engine pulling all this profit,
yeah,
that has to be the core internal combustion engine business. The ICE segment is still the cash cow, right?
Absolutely. The ICE business remains the profit engine, no question. And these Q3 results are just proof of superb execution in their most lucrative segments. Trucks and SUVs. GM was the #1 automaker in total U.S. sales. They delivered 710,000 units. That's up 8% year over year.
And that translates into real market share gains, too. They hit, 17.0% U.S. market share in Q3. That's their highest Q3 share since 2017. Yeah. There's real dominance in a tough market.
It's not just dominance. It's dominance where it counts, financially speaking. It's franchise power. They're on track to lead the industry in full-size pickups for the 6th straight year, holding a 41% year-to-date share there. And get this, they expect to lead in full-size SUVs for the 51st straight year, commanding 60% of that market year-to-date.
51 years. Just think about the brand loyalty, the customer stickiness needed for that kind of power. They even had their best year-to-date Escalade sales since 2007, apparently. This ICE profitability. It's the lifeblood funding the whole transition.
And that leads directly to the second key factor, Pricing discipline. It's crucial. They're selling high volume, yes, at high prices. Without resorting to deep discounts, their average transaction prices, ATPs, were consistently over $51,000. But here's the really key metric. Their incentives, as a percentage of that ATP, stayed exceptionally low, just 4.0%.
Wait, hold on. 4% incentives. When the industry average is what, nearly 7%, 6.9%? That is extraordinary pricing power. It shows they're selling what they make, and customers are willing to pay up for it.
It's proof positive their franchise segments are working extremely well. They're maintaining one of the industry's lowest incentive levels, and that flows directly to those boosted adjusted margins we saw earlier.
And that strong domestic story, it had some solid support internationally too, didn't it?
Yes, definitely. GM China achieved its second consecutive quarter of year-over-year growth in both sales and market share. That's a positive turnaround there, partly helped by new energy vehicle sales. And GM International overall was helped by the successful restructuring of their China joint venture. Oh, and we shouldn't forget GM Financial, their lending arm. Its EBIT-adjusted income increased year over year to $804 million. So yeah, everything seems to be firing on all cylinders on that ICE side of the business.
Okay, let's pivot now. We've talked about the strong core business. Let's look at the operational pressures. We mentioned the $1.6 billion charge, sure, but even with the ICE business doing so well, profitability in North America took a serious hit. That North American adjusted EBIT margin declined significantly from 9.7% last year down to 6.2%. How does an operational powerhouse like that lose nearly a third of its core regional margin in just 1 year? That seems like a serious vulnerability.
It does, and management was very specific about it. They called out two major pressures driving that compression. Externally, they absorbed $1.1 billion in tariff costs. That's huge. And internally, they saw a big hit from a $0.9 billion increase in warranty-related expenses. Those two factors account for the bulk of that margin decline.
$1 billion in tariff costs alone. That's massive. What's the plan to mitigate that going forward? Because that feels like an ongoing headwind.
They are working on it aggressively. The forecast for the gross tariff impact for the whole year, 2025, was actually lowered slightly. It's now expected between $3.5 and $4.5 billion, down from $4 to $5 billion. So, some improvement. But more importantly, they expect mitigation actions, including benefits from a new MSRP tariff offset, to cancel out about 35% of that tariff base. So they are actively attacking the problem.
Okay, and speaking of attacking problems, let's circle back to the EV transition. We know they took the big charge to right-size capacity, but are they actually succeeding in the EV market in terms of volume, selling cars?
Well, yes, in terms of volume, they are succeeding. GM has solidified its #2 spot in U.S. EV sales. They delivered a record 67,000 units in Q3, capturing about 16.5% of the U.S. EV market share, and the Chevrolet Equinox EV. It's now the best-selling non-Tesla EV out there. Plus, Cadillac is the best-selling luxury EV brand year-to-date, so the customer demand is definitely there for certain models.
The customers are there, but the profit isn't, broadly speaking, which is why we saw that $1.6 billion charge.
Exactly that. The CFO noted that only about 40% of their current EV lineup is profitable on a contribution margin basis. And that's the core challenge, isn't it? The need for this strategic realignment stems directly from that profitability gap, combined with, as we said, the realization that near-term EV adoption is just going to be slower than they first thought.
So the action plan is basically stop building cars you can't sell profitably. Rebalance production to meet the actual consumer demand curve, not the overly optimistic projections from maybe a year or two ago.
That's pretty much it. Management is being very specific. They're reassessing our EV capacity and manufacturing footprint.
Yeah.
The goal is to drastically reduce the losses they're projecting for 2026 and beyond. It's less about slamming the brakes on EVs and more about aligning capacity with profitable demand and, crucially, supply chain efficiency.
Okay. This brings us neatly to the future focus. It seems crystal clear now. The company's pivoting hard towards profitability above all else. What are the two biggest strategic targets they're pointing to kind of secure that future?
Well, their absolute top priority, #1, is restoring those North America adjusted EBIT margins, getting them back to that aggressive 8-10% range over time. And that depends on hitting three things almost simultaneously: driving EV profitability eventually, maintaining that ICE pricing discipline we talked about, and further reducing that multi-billion-dollar tariff exposure. It's a tall order.
Right. And the second strategic lever, this is maybe the most exciting one for investors, I think, the software and services business. This is the segment that really promises to maybe change the company's valuation, move it from just a cyclical automaker towards, well, a high multiple tech player.
Yeah, the momentum here is pretty undeniable. They've already recognized about $2 billion in revenue just year to date from things like Super Cruise, OnStar, and other software services. But what's truly revolutionary, I think, is the deferred revenue pipeline. Deferred revenue is nearing $5 billion at the end of Q3. That's up over 90% year over year.
A 90% jump in deferred revenue.
Yeah.
That's a massive indicator, isn't it? It means customers are signing up for multi-year deals, creating these predictable, recurring revenue streams, very different from just selling a car.
Precisely. And the key appeal here, as you alluded to, is the margin profile. It's huge. They're projecting robust double-digit revenue growth from this whole segment through the end of the decade, with gross margins approaching 70%.
70%, wow.
Yeah. That level of profitability fundamentally changes the risk-reward profile of GM as an investment, you know?
A 70% gross margin certainly makes that 6.2% North American vehicle margin look positively anemic by comparison.
Yeah.
Explains the heavy investment there. Tell us about the subscription numbers. How's that going?
It's growing well. They ended Q3 with over 11 million OnStar global subscribers. That's a big base. And the adoption of Super Cruise, their hands-free driving tech, is accelerating really rapidly. They finished the quarter with over 500,000 active Super Cruise subscribers. And they're on track for over 600,000 by year-end. That's a massive year-over-year jump. And these subscribers, they pay recurring fees. It turns hardware into a software service.
And they're using tech not just for selling services, but also internally, right?
Yeah.
To boost efficiency, which helps maintain that pricing power we discussed.
That's right. They're deploying AI and robotics pretty heavily to drive efficiency in manufacturing and sales. Using digital twins to simulate production lines, that allows faster scaling, saves costs before you even build anything physical. And get this, they use an AI recommendation engine to help North American dealers match their inventory precisely to local demand patterns.
Huh. So the system tells the dealer, you need this color truck, this trim level, based on local data, which reduces the need for costly incentives later, supports that low 4% incentive rate. It all kind of connects back to operational discipline. Okay, so this deep dive really shows us these two parallel realities playing out at GM. On one hand, they're relying heavily on that incredibly robust, profitable ICE business that are pay the runks, the SUVs to fund everything else. And on the other, they're making a more cautious, maybe more realistic, but still highly promising long-term shift towards EVs and, critically, software recurring revenue. The confidence shown by raising guidance that tells us the operational strength is real, and it's translating directly into rewarding shareholders. They bought back $1.5 billion of stock in Q3, paid down $1.3 billion of debt. That shows flexibility.
That financial flexibility is absolutely critical for managing this kind of complex transition. So GM is committed, as they say, to restoring North American margins to that 8–10% range, while also significantly reducing tariff impacts, accelerating software revenue, and restructuring EV capacity. That's a lot to juggle. So given that complexity, navigating simultaneous growth in software, stabilizing ICE volume, recalibrating EV production, here's something for you to think about. Which of these three core variables, the ongoing ICE profitability, the EV capacity right-sizing, or that software revenue acceleration, which one will prove to be the most decisive factor in actually hitting that 8–10% margin target come 2026? Think about which lever truly holds the most transformative power for the future of General Motors.